investors, and welcome to my channel, where I study value investors and great businesses. Today we'll be taking a look at Buffett's ultimate referral, Bill Ruane. In this video, we'll be covering the four key parts. Number one, the life of Bill Ruane and his four guiding principles. Number two, Bill Ruane's Sequoia Fund and the concept of finding success with wonderful businesses at fair prices. Number three, the Sequoia Fund performance. Number four, the current challenges for Sequoia's post-Ruane's leadership. Warren Buffett officially retired from managing outside money in 1969, but he did so on a high note, focusing on Berkshire Hathaway's permanent capital base. Despite the fact that Buffett's fund was closing, many of his limited partners were still interested in investing in a value-oriented fund. Buffett offered his investors the option of receiving either shares in the partnership's controlled companies, Berkshire, blue chip stamps, etc., or a cash-only distribution. Buffett only recommended one place to investors who chose cash, Bill Ruane's Sequoia Fund. But why did Buffett pick Bill Ruane's Sequoia Fund over the rest of the super investors of Graham and Doddsville? Keep watching to find out why Buffett chose Bill Ruane's Sequoia Fund for his former clients. First, we'll be taking a look at the life of Bill Ruane and his four guiding principles. William Ruane's life sounds a lot like Charlie Munger's. He was born in the mid-1920s and worked as an electrical engineer after World War II. He went to Harvard Business School in search of a career change, where he developed an interest in investing after reading Graham and Dodd's security analysis. Ruane started his career as an investor at Kidder, Peabody & Co., and he continued his education by enrolling in Graham's Columbia Business School class, where he met Warren Buffett. For the next 20 years, the two remained in contact. Ruane built a strong reputation for generating above-average returns while managing money at Kidder, Peabody & Co. Buffett knew that some of his partners preferred to continue investing in a fund-type structure when he decided to retire from the fund management and invest through permanent capital. Ruane was Buffett's only choice for a worthy successor for his investors because of his knowledge and track record as a value investor, as well as his strong character as a professional money manager. He persuaded Ruane to open his own shop, and Ruane got the ball rolling. In the words of Ruane, Rick Cunniff and I formed an enormous firm together, and within a year, we had established our first mutual fund. This fund referred to, of course, being the Sequoia Fund. The Sequoia Fund has consistently outperformed the S&P 500 since its inception in 1970. $10,000 invested in the start of this fund would now be worth $4,223,193. In the S&P 500, $10,000 would have grown to be about $1,354,116. Bill Ruane's Sequoia Fund outperformed the market not by timing the market or chasing trends, but by sticking to simple value strategy similar to Warren Buffett's from the 1970s onwards, focusing on long-term investing. This strategy consisted of four guiding principles, which we will now delve into further. Financial author William Green learned about these four guiding principles of investing in a rare interview with the late W.J. Ruane. W.J. Ruane's four guiding principles of investing are: number one, do not use borrowed money to buy stock. When you borrow money, you don't act rationally. Number two, be wary of momentum. If you see markets going crazy, either because the herd is panicking or because stocks are being bought at irrational prices. Number three, don't listen to market forecasts. I am convinced that no one can predict what the market will do. The most important thing is to come up with an appealing concept and invest in low-cost companies. Number four, invest in a small number of stocks that you have thoroughly researched and for which you have a competitive advantage in terms of information. Regular investors, on the other hand, have a more secure path to success. The majority of people would be much better off investing in an index fund, and Ruane believed that, on the other hand, concentration was seemingly the best strategy for investors looking to beat the market. Bill Ruane was one of his generation's most successful stock pickers because they both invested using Ben Graham's value investing principles. When Buffett closed his investment partnership in 1969, he recommended Ruane as a replacement for himself. Ruane's first three principles are crystal clear to me. Indeed, I haven't come across any qualified content that challenges these assertions. The fourth principle may be the most contentious. Investment concentration and or investment diversification are two different options and schools of thought that Ruane acknowledges. While both Ruane and Buffett defend the superior practice of value investing and stock picking, concentration of investment in a few stocks, they acknowledge the practicality for the average/regular investor to avoid the risk of concentration and stock picking by diversifying with index funds. It is critical, in my opinion, not to misunderstand the meaning of Ruane's regular investor or Warren Buffett's average investor. You don't have to be great to succeed as an investor. As Jack Bogle once said, to be successful, you don't have to outperform the market. There's something thrilling about the prospect of outperforming the market. I understand. The simple truth is that being in the market, riding the market, already gives you excellent long-term investment results. Furthermore, financial data shows that most professional and retail investors who attempt to beat the market by picking stocks fail and underperform the most popular market benchmark, the S&P 500. So, how did Bill Ruane's Sequoia Fund earn Buffett's recommendation? Well, it's not every day that you start a fund management company and immediately receive referrals from a well-known investor, but that's exactly what happened to Ruane. There's more on the story, of course. Here's an excerpt from the Sequoia Fund under his leadership. We own quality businesses run by quality people that can compound their earnings rapidly. We hold these businesses over a long horizon with the mindset of long-term business owners. We buy them for less than what a conservative business person would pay for them, and we focus on our best ideas while avoiding excessive concentration. All along the way, we strive to make thoughtful, rational decisions based on intensive primary research. At the core of our strategy is the belief that if we pay attractive prices to own businesses that are higher quality and faster growing than the average S&P 500 company, then over the long term our portfolios should earn a higher return than the S&P 500 index with less fundamental risk. Fund overview: the Sequoia Fund. Buffett set the barometer for Ruane's success at 4 percentage points above the S&P's return, and even as the fund grew into a multi-billion-dollar portfolio, Ruane was able to beat this metric. Ruane's Sequoia Fund became one of the industry's best-performing mutual funds. The market is a voting machine in the short term, but a weighing machine in the long run. Bill Ruane's Sequoia Fund, like Graham, Buffett, and other super investors, bought stocks at a discount to their intrinsic value and held them long enough for the market to recognize it. Investing in wonderful businesses at a fair price rather than old school cigar butt, the Sequoia Fund adhered to solid criteria that separated the wheat from the chaff. Companies with a competitive advantage or moat, quality management, and long-term focus on compounding value for shareholders were targeted by the Sequoia Fund. This strategy, like Berkshire's, suited the company's larger capital base. When conducting due diligence going beyond the numbers, Sequoia's due diligence didn't end with the number crunching. Sequoia used scuttlebutt information as Philip Fisher to flesh out the benefits and drawbacks of a potential investment. Before taking a position, the fund would spend months, if not years, conducting this thorough due diligence. This resulted in a portfolio of high conviction ideas. Sequoia didn't spread its bets around. Its high conviction mantra meant that a portfolio of as few as 10 stocks. Although the fund is now more diversified, it is still more concentrated than the average. The top 10 holdings make up 65% of the portfolio. While the fund's approach to value investing differs from ours, it was successful because it focused on the most important factor: market beating returns from a simple value strategy. Bill Ruane's Sequoia Fund didn't try to predict the unpredictable or chase macro trends. Instead, it carefully selected high quality stocks that the market had not fully valued. This approach is far more difficult than our simple value strategy, but it can still produce market beating returns if done correctly. Now, on to the second topic, which covers Bill Ruane's Sequoia Fund and the concept of finding success with wonderful businesses at fair prices. It's fascinating to see how the Sequoia Fund's meteoric rise parallels Buffett's transition from cigar butt to moat investor. Sequoia's success was built on investing criteria oriented towards wonderful businesses at fair prices. According to Ruane, who was an early Graham supporter, Ruane was managing a larger sum of money than Walter Schloss and other cigar butt style value investors, and he was unable to build meaningful positions in those more illiquid names. He was able to use highly developed criteria and exhaustive due diligence to find mid-cap and large-cap stocks that were undercovered and undervalued by the market by adopting a wonderful business at fair prices philosophy. Sequoia invested heavily in these stocks and held them for a long time. The Washington Post Company, a well-known Berkshire holding, the Interpublic Group, and Ogilvy and Mather were all successful purchases in the 1970s. Kraft, Sara Lee, Capital Cities Broadcasting, another major Berkshire holding at the time, Fifth Third Bank, Johnson & Johnson, and Harley-Davidson were all runaway successes in the 1980s and 1990s. Ruane's ability to crush the market with blue-chip names may appear strange, but it's easy to see it that way in hindsight. The larger companies Ruane invested in were gems hiding in plain sight, well-known stocks that were erroneously undervalued by the market. Thirdly, let's look at the Sequoia Fund's performance. The rock star status of the Sequoia Fund extends beyond its market-beating returns. Bill Ruane's Sequoia Fund operated with the same honesty and availability that Warren Buffett has given to his investors in an industry with a spotty reputation for integrity, both in the partnerships and at Berkshire. Mutual fund managers, it is fair to say, have interests that are not directly aligned with those of their investors. This is understandable given that their fee structure is asset-based rather than performance-based. This makes it all too easy for fund managers to be more concerned about outward appearances than with actual performance. Many mutual funds are closet indexers constructing portfolios that track the S&P 500 and other indices, albeit with returns that are statistically lower than the benchmark. Mutual fund managers are content with mediocre to average performance in comparison to the markets as a whole because they always earn their 1% asset management fee. Overcoming the moral hazard created by this business model, Sequoia realized that putting the investor first was the key to mutual fund industry's long-term success. Bill Ruane's Sequoia Fund was decades ahead of the competition in terms of sound shareholder communication, prudent fund governance, and low-cost, low-turnover philosophy. Sequoia's no-nonsense approach mirrors Buffett's approach at Berkshire Hathaway, demonstrating how, in the long run, character is more important than experience when choosing a successful fund manager. For our fourth and final topic, let's analyze the headwind the Sequoia Fund faces post-Ruane and how it plans on keeping its legacy alive. Although William Ruane died in 2005, the Sequoia Fund continues to operate. The years following his death, on the other hand, have not been as fruitful. Sequoia has had to adapt its strategies under the leadership of Robert Goldfarb and David Poppy in order to keep up with changing market dynamics and the larger sums of money, billions, under management. Information accessibility and market automation have made it more difficult to find undervalued stocks in the mid to large cap space because small cap markets are too small for more institutional investors. They remain inefficient, which is one of the reasons why individual investors can gain an advantage by focusing on small cap value stocks. As a result, Sequoia Fund's managers have attempted to apply past strategies to the current market environment with disastrous results. Take, for example, Sequoia Capital's investment in Valeant Pharmaceuticals. Valeant appeared to have a winning strategy of acquiring existing drug companies and raising prices. However, the story stock lost its luster after a series of costly acquisitions and an accounting scandal. Sequoia made a large investment in Valeant at the time when the stock was hitting new highs, resulting in a highly concentrated position. Sequoia's returns soared in the early 2010s, but they plummeted when Valeant stock plummeted. Sequoia lost billions after seeing its Valeant stock. To be fair, Sequoia was not the only well-known investor who succumbed to Valeant's seduction. Bill Ackman, John Paulson, and others lost money on their Valeant investment. Bill Ruane most likely would not have recommended Valeant as an investment. Valeant appeared to be a likely multi-bagger at first glance, but Valeant, on the other hand, was an unsustainable financial engineering scheme, an investment idea that might have worked for a quick buck artist, but was not a good fit for Sequoia's long-term portfolio. The Valeant episode demonstrates what can happen when a fund with a strong track record is no longer led by its illustrious captain. Although Greg Abel is nothing to sneeze at, it's an important cautionary note to keep in mind whenever Buffett is no longer at the helm of Berkshire Hathaway. And so we come to the conclusion of the video. Sequoia brought businesses rather than stock symbols, rather than chasing trends and predicting the unpredictable. Sequoia stuck to its own investing criteria based on proven strategies. While it's difficult to find businesses that can compound for years, if not decades, Sequoia's extensive research process and large asset size enabled it to conduct the thorough due diligence required to identify these winners. Sequoia clung to its guns under Ruane's watch. When Ruane was in charge of Sequoia, he beat the market by sticking to a strategy that he knew worked. His successors, as seen in Valeant, have taken a different approach, which has often resulted in disaster. Ruane's investing philosophy was necessary for a large fund like Sequoia to outperform the market, but you, the individual investor, may have it easier. You have a larger pool of small cap, deep value opportunities from around the world when you work with a smaller capital base. Sequoia Capital needs to put hundreds of millions of dollars into a position that moves the needle, but you can turn a stock that only trades for a few thousand shares per day into a major position. Thank you for watching this video entirely to the end. Nothing helps me out more than y'all sticking it out to the end. Please consider subscribing to my channel if you haven't already done so. Also, if you enjoyed this video, please like and share this video so that we can continue to make videos like this for you to enjoy.